The Federal Reserve, it can cut interest rates to fight a recession, but it cannot raise them to fight inflation. Pick your poison. You are trapped between a rock and a hard place. Do we try and fight inflation at the expense of a recession and a slowing economy? The problem is that the Western system is so far indebted that in a recession, the ability to service the debt is compromised, which leads to a default. This is why governments have chosen inflation over austerity always. When you see a VIX that rises that high, spiking that fast, it tells you something very bad is happening. Something very ominous is happening. If I were advising my son or my nephew or my best friend, and I had all of these accumulated profits in the Magnificent Seven, I would remember that profit is not a 4-letter word. It is a 6-letter word, and you'd be far better off to take some of those profits now before you give them all back. In a world edging towards economic collapse and societal upheaval,
we're up against a real polycrisis.
Inflation is eating away at our savings.
A shaky banking system is putting our financial security at risk.
Government debt
There's unthinkable record highs.
and the wealth gap keeps growing thanks to an unjust monetary system.
Add in AI,
And advances in longevity disrupting jobs,
a looming property crisis,
geopolitical tensions.
and it's clear we've got our work cut out for us.
Our podcast is here to offer some hope
We're all about navigating these challenges by advocating for sound money principles.
and smart use of tech,
Our goal is to help you take control of your financial future
showcasing resilience, determination.
and practical solutions in these turbulent times. My name is Jason Cozens, founder and CEO of gold currency platform Glint.
And I am Andy Schectman, CEO of gold bullion dealer Miles Franklin. Welcome to the Resilient Compass podcast.
A quick one before we get back to this episode. Just give me 30 seconds of your time. There are two things I want to say. The first one is I want to say a big thank you to the army of you who already work with us as clients and who support our mission. And for those taking the time to tune in and listen to the show today, your support is very important. And secondly, we are just getting started. And if you like what we are doing, please hit the subscribe button and add your comments below. We need to know what matters to you. It is really important to help us grow and spread our mission. Thank you. Now back to the episode. Hey everybody, let's get started. My name is Jason Cozens. I'm the founder and CEO of Glint, and I'm here with my co-host again, Andy Schectman, who's the founder and CEO of Miles Franklin. We've got a full rundown. We've got Monday's stock market crash to talk about, which is on the lips of everybody, I think, at the moment. Of course, gold's resilience in the face of that tsunami. What this means for the wider economy, and even touching on the East-West aerospace squeeze that's happening because of geopolitical conflicts. And we'll finish off a little bit on the proposed U.S. strategic Bitcoin reserve, which is being led in the United States. Andy, I'm flying back from Singapore, and I woke up midair on the flight from Asia on Sunday to find out there was a global market sell-off was well underway. The Japanese market plunged 12%, which is an historic drop, the worst since Black Monday in 1987. Quite the thing to wake up to on an airplane.
Yeah, you know what, Jason? I've said for a very long time that I believe all of this chaos will happen over a Sunday night, Monday morning. Now, it's a little bit different from your perspective because you're over on the other side of the world where the timing is more in line with the global south. Here in the United States, we're hours behind, and true to form, you wake up on a Monday morning and everything has changed. There's no time to prepare. And that's the thing about being proactive rather than reactive. This is the whole reason to look at gold as wealth, as insurance, something that we own as a insurance policy to protect us against what may happen. And you don't call your car insurance agent as you're in the process of getting into a car accident. So you have to be proactive. And when we take a look at what's happening in Japan, people should have known that this was coming. And the Nikkei had been in a free fall for quite some time. And the extraordinary efforts that the Bank of Japan had attempted to implement to strengthen the yen looks like has resulted in a disastrous effect, if you will, at least on the unwinding the potential disastrous effects that we haven't even seen the end of yet, as the carry trade that has been so very bullish in many respects to assets in the United States unwinds. And I think that this is something we haven't really begun to see the end of yet. To your point, the Nikkei fell by 12.4%. That's the biggest one-day drop ever in the history of the Nikkei, over 40, almost 4,600 points. And of course, it reverberated through much of the world, where we saw the same thing happen here in the United States, the biggest one-day drop ever, over 1,000 points, and big drops in other parts of Asia. And I find it also interesting that as this happened, you had multiple brokerages, including Charles Schwab, Fidelity, Vanguard, TD Ameritrade, E-Trade, even UPS, CenturyLink, and Interactive Brokers were all down or reporting errors amid the market crashes, even Robinhood. And when you have the biggest drop in a 24-hour period ever, where the Nikkei loses the most ever, where Taiwan has its worst day in 57 years, where South Korea has its worst day in market since 2008, where 61% of Americans own stocks, and yet all of these exchanges were halted, is very scary. In other words, they weren't allowed to move. People weren't allowed to move out of their positions had they desired. And this interconnection with the technology behind these brokerages and the inability to move them as the markets were collapsing is equally as frightening. So yeah, as the Chinese curse says, brother, may you live in interesting times. These are surely interesting. And as this carry trade unwinds, and all of these people who were able to borrow inexpensively in yen at, let's say, 0.5% interest, and switch to dollars and buy treasuries in dollars yielding 5%, that spread that they've made has been free money for a very long time. But as the yen now is strengthening due to the intervention of the Japanese central bank, all of these trades are getting margin calls, and the unwinding can be disastrous to some hedge funds and some large institutions. And I think we haven't seen the end of it yet, to be sure.
No, and we've seen a lot of these apps and platforms like Robinhood, for instance, going down during the GameStop, when that started to rocket last time. And I just can't help think, but actually, I'm sure the bigger players were able to still trade, and it just shows you how much I think the everyday person is being shafted to a degree.
And one other point I'd like to make real quick, just about the falling yen. If we go back 10 years ago, Jason, an ounce of gold was about 140,000 yen. And now it's almost 400,000 yen. It's 385,000 yen for an ounce of gold. And so when you talk about what gold is supposed to do, this is exactly what it's supposed to do. As the currency underneath it was being destroyed, in essence, losing value precipitously, gold quietly kept pace and actually accentuated its purchasing power. So gold is not owned to become wealthy. Gold is wealth. And gold is wealth that is the barometer by which we measure the health of any given currency. So keep that in mind as you consider owning gold. It is not to become wealthy. It is because exactly a situation like we saw in Japan. And in reality, how much different are we than they are? They just are a few years ahead of us in the cycle. I would argue that something along this line is in store for the United States and for the United Kingdom as well.
Yeah, and gold, of course, did its job. As you said, it always does its job. In the medium to long term, gold prices maintained their position above the $2,400 despite minor fluctuations. But what else do you think is actually supporting the gold price here?
I think what you see is massive central bank acquisition. That is what is supporting the gold price, because the conventional wisdom in the United States would say, geez, you have positive real yield. That is, if we believe the CPI numbers, but taking the CPI numbers at face value when measured against Treasury, yeah, there's a positive real return, 3% inflation, 5% on a short-term Treasury. That's terrible for gold. You have a strong dollar, terrible for gold. And we show ETF outflows out of the West at a 45-degree angle, which means the public is not participating. Terrible for gold. So if the Western retail investor is completely ignoring what gold has been doing all of these years and is instead focused on things like Nvidia and Bitcoin and Apple and really not part of this rally. What happens when they become interested? What we see instead is a massive drive to accumulate gold by the central banks of the world, because I believe gold will become central to a new system, whether it be the new unit settlement token coming out of the BRICS New Development Bank, or the IMF acknowledging that any central bank digital currency that is not pegged to something like the only other tier one reserve asset in the world, gold, reminiscent from their report that they wrote early last year saying gold as an international reserve currency, comma, a barbarous relic no more, question mark. You have the IMF acknowledging gold's role in currency. And the more things change, the more they say the same. They say history doesn't always repeat, but it certainly rhymes. And that's what we see here, is that the realization that the further away you get from gold as a tether to fiscal sanity, the more likely that we return to it. And that's what it appears to me we are doing. So all of these central banks that are accumulating gold and bringing it home and repatriating it, they are the big players in the space that are keeping the price up. I can only imagine the fuel, the rocket fuel, when the American public, the Western public, where Rick Rule will say the total allocation from Joe and Jane Sixpack to the Harvard Endowment Fund in the United States is 0.5%. Well, what happens if that turns to 5%? Just 5%. Well, that's a tenfold increase in demand. So you're looking at massive rocket fuel potential once the public wakes up. But unfortunately, Jason, as is the case, it will be one of these Monday mornings when the public wakes up to a realization that, why am I not invested in gold and silver? What have I been doing? Where before I think you get that involvement.
Yeah, and I think central banks clearly see gold as the currency of last resort. It is really the only currency in the world. Everything else is debt. Even, of course, there's a lot of enthusiasm within our friends in the crypto universe. Bitcoin is still a risk-on asset. It plummeted alongside all the stocks as well. There's going to be a long time before it ever becomes, I think, a risk-off asset like gold. Gold is the only form of money. And of course, I think everyone in Asia and the East sees that. And of course, apart from central banks, you're also still seeing a lot of retail demand over there, unlike we're seeing off here. So I agree with you. As soon as interest rates come down, what is that going to do to the gold price? And there's been a bit of chatter as well, Andy, about yield curve uninversion. Now, it's a slightly complicated phrase. It's a little bit difficult to understand. Can you explain a little bit about that to our listeners?
Yeah, so when the yield curve gets inverted, it's a very unnatural, unusual phenomenon. It's where short-term interest rates are higher than long-term. Now, if I wanted to borrow 10 ounces of gold from you, Jason, and said, can I pay you back in 60 days? You may say, sure, I'll do it at 3% interest, 2% interest, whatever that interest level is. Fine, let's do it. And then I say, Jason, can I actually borrow it for 3 years instead of 60 days? What would that interest rate be? It would have to be higher, not only for the potentiality of default on my behalf, but also your loss of the use of that money. And so the interest rate should be higher. When we have an inverted yield curve where interest rates are higher now than they are down the road, it is an ominous sign for the economy. It says that there is not much confidence, if you will, and in moving out further. And so when we see the yield curve uninvert, normally that, in fact, if you go back to 1950, in every instance that is uninverted, it has predicted a recession in every single uninversion since 1950. And what is more ominous about this particular uninversion to me is that what we are seeing, instead of the long-term rates going higher than the short-term rates, we're seeing the short-term rates drop beneath the long-term rates. In other words, I believe what is happening is that the bankers who understand what's coming would rather plow all their money into very short-term treasuries, not risk it to duration, because any long-term duration treasury right now has to be considered risky with inflation and default risk and geopolitical risk. And the same thing is true for the bankers who are thinking of lending money out into the system. I don't want to lend money to you and you. It's too risky. Instead, I'll give it to the Treasury and earn 5% on 6-month yield treasuries, on short term treasuries, 2 year or less in duration. And they're beginning to fall because the more money that gets plowed into those treasuries, the value goes up, the interest rates go down. So, my mind, what is happening is the insiders, the bankers, instead of lending money out into an economy they view as fractured and dangerous, they are plowing it into short term treasuries. That's not a good sign. That is not a good sign for the health of the economy moving forward. And it has every single time since 1950 predicted a recession. So, if indeed they do lower rates to stimulate a slowing economy, and this does predict a recession, and we began to see the economy slide into a deep recession, as this has been maybe the most inverted, longest inverted yield curve in history. Does that mean that the ensuing recession could be the longest, deepest, all the way into a depression? Maybe it could. And so, what that would tell me is that interest rates, they will do all they can to push interest rates down on the front end of the curve, to do the best they can to stimulate the economy, to inject money back into the system, to do what governments have always done, and that is to choose inflation over austerity and light a fuse under the gold market. So, yeah, I think that is, again, there's a lot of black swans out there. This is one of them as well. Is it predicting a recession? I guess we'll see, but every single one since 1950 has indeed done just that.
And there are huge levels of leverage and I think there's a lot of risk inherent within that leverage, isn't there?
100%. The more levered something is, the greater the potential for upside risk, but it cuts both ways. The greater the pain as it unlevers. And you're seeing that, for example, in the yen carry trade. And so, yeah, leverage is great in an upward moving market. It can kill you in a downward moving market if you're on the wrong side of it. So there is a tremendous amount of leverage baked into this entire system through derivatives, and more so than I think people even understand or comprehend. All of that, I think, will have to be dealt with as we see things unwind in this environment we are heading into.
Yeah, and we've both predicted this before. Lots of people have within our space. The financial market turbulence was expected. Of course, the central banks are going to reverse their. That does to gold, of course. The environment for that gets better. And we can anticipate, I think, continued equity market volatility during this time. And of course, all of this is further highlighting, of course, as you said, gold's safe haven value. And I'm sure that will continue for the year ahead. The current monetary system just doesn't support stability. We see this time and time again. Here we're seeing it again. The Japanese stock market collapse was stimulated by some surprise action when they increased interest rates. We've seen it again with the Fed in the US. And without the constant monetary injection that we're seeing, which has been withdrawn recently with quantitative tightening, as we know, asset prices drop sharply. This is what we're seeing. So the current monetary system just doesn't support stability, does it? Without constant money injection, which has been withdrawn with all this quantitative tightening, asset prices, of course, drop sharply, which is what we've been seeing, until the central banks intervene once again and the cycle repeats. And all of this, of course, underscoring that financial and monetary factors often drive turbulence rather than economic benefits. It's a whole house of cards. All this leverage within the system, all this interference by central banks is creating this really precarious situation. We saw last year, of course, with the banks who'd bought all the government bonds as they were instructed to do by the Fed. Once the Fed put up interest rates, they were in trouble. It created massive issues for those banks. And I'm sure some of those problems aren't gone either. It creates all this leverage is, and all this intervention creates a system which basically could collapse.
I would add to that the heavy weight of the Western debt reduces the ability to move freely, to react, in the respect that the Federal Reserve, it can cut interest rates to fight a recession, but it cannot raise them to fight inflation. And so pick your poison. You are trapped between a rock and a hard place. Do we try and fight inflation at the expense of a recession and a slowing economy. The problem is that the Western system is so far indebted that in a recession, the ability to service the debt is compromised, which leads to a default. This is why governments have chosen inflation over austerity always. And the Federal Reserve is always a day late and a dollar short in their movements. And so my guess is what we are beginning to see right now is 5% interest rates working through the system. It takes a year or two for all of that to work through the system, and we're beginning to see the ramifications of that. And they will cut, and they will cut too late. But cutting is what all governments have done since the beginning of time, and it just decreases the trust and the belief that the West will ever normalize their balance sheet. And we won't. We can't. We're in a very difficult position. This is why, for my money, I bet on gold. And this is why you're seeing such massive central bank acquisition of gold, because they too understand mathematically, economically, and logically that the West is very near the end of its rope, and doing all they can through these gyrations that the Federal Reserve thinks is the elixir that the economy needs to be healthy. All they're doing is distorting asset prices and creating misallocations of capital and resources that, when they unwind, when Mother Nature gets her way, there'll be problems. Let's say it another way. In 2008, at the end of the great financial crisis, the balance sheet of the Federal Reserve was $800 billion. At its peak here recently, that balance sheet was $9 trillion. It may be a little less by $8 trillion now. But what would the economy have looked like over the past 15 years had we not seen $8 trillion worth of liquidity added into the system in the form of bond purchases, which kept interest rates low, which stimulated the economy, which make going into debt easier, which raised asset prices of 401ks and real estate? What happens when rates rise? Just as bullish as it was through suppression of interest rates and easy money, it will be exponentially more bearish as all of this with the leverage attached to it unwinds. And I think that is potentially what we have just witnessed with the pricking of the bubble and the stopping of the yen carry trade, which has been incredibly bullish for US based assets, that you're getting margin calls across the globe right now that will make people think real hard about continuing this carry trade. One of the byproducts of all of this volatility and this craziness in the markets is something called the VIX. The VIX is a measurement of the volatility within the system, and it's calculated based on market pricing for options on the S&P 500. It's often designed to measure the expected volatility over the next 30 days. And what we saw was the Monday morning peak just 2 days ago was the high, or yesterday rather, was the highest level the VIX has hit since March of 2020, right after the Fed came in with their emergency actions during the COVID pandemic. And so when you see a VIX that rises that high, spiking that fast, it tells you something very bad is happening, something very ominous is happening, and that the traders are very concerned about these positions. So it has fallen back a bit, but I think that's unjustified as well. Quite frankly, I think this market justifies a very high VIX. This market justifies a warning sign, and to not expect greater volatility is foolhardy. I think that this is just the beginning of great volatility, in particular when you have the Magnificent Seven, which have been killed lately, leading the way, and the rest of the markets underwater. You look at the Russell 2000, which is a broad measurement largely of the US economy, a much better indication than the NASDAQ or the Dow. And it's funny, the NASDAQ, which is supposed to be all tech, has more industrial and financial stocks in it than it does tech stocks. Everything's all distorted right now. And it's because to maintain this illusion. But the bottom line is that as these seven stocks get clobbered, what happens to the rest of the market? 60+% of Americans own stocks. The majority of them, if they're still in the market, have been riding those seven stocks, because the majority of stocks in the Russell 2000 are down. In fact, if you would have bought 30 stocks, not the seven that have gone up, but 30 other stocks in the NASDAQ, in 2022, you'd be underwater today. It's those 7 stocks that have held up the entire market. That lack of breadth is always portrays great market volatility and trouble ahead. And here we're seeing weakness in the tech sector. What does that say to the broader market altogether? Volatility is here to stay. And if I were advising my son or my nephew or my best friend, and I had all of these accumulated profits in the Magnificent Seven, I would remember that profit is not a 4-letter word. It is a 6-letter word, and you'd be far better off to take some of those profits now before you give them all back. And if indeed we see the current administration retain the White House, they are advocating for taxation of unrealized gains, which is absolutely un-American. But you can expect higher taxes for sure. You can expect higher capital gain rate for sure. And if you have enough wealth in your portfolio, a taxation on unrealized gains. And so, yeah, again, we have the biggest election in the history of this country coming up in 100 days or so. To expect there not to be tremendous volatility. Look, 2 weeks, 3 weeks ago, when President Trump was almost killed, you could say we are 1/2 inch away from craziness versus relative calm. And look what's happening in the streets of London right now. Look what's happening all around the world. The world is wound very tight. And I think everyone is waiting for something to break. And to expect smooth sailing between now and the election, I think, is foolhardy. So this is the time to not be risk on. This is the time to be risk off. This is a time to worry less about return on your money and more about a return of your money. And I think that is found in things like gold that remove the counterparty liability issue. And I think that's why you see the central banks of the world doing all they can before the people realize it to accumulate and retain their precious metals, and in particular gold, which is the world's only other tier 1 reserve asset. Yeah, things are getting interesting, to say the least.
I know a lot of our viewers are in the United States, and geopolitical issues on the other side of the world sometimes can feel very far away. But I just want to bring something home to people. I was flying from Asia on Sunday night, as we discussed early on, and I got chatting to the pilot, and he highlighted that the ongoing geopolitical conflicts were coming together to create a real problem for flights between the East and the West. We've obviously got the war in Ukraine, and with Russian aerospace is closed down for people in the West. Then you have the conflict in the Middle East as well. What it's done is it's create this reduced safe airspace. And so actually all the flights between the East and the West, and I wonder if, Ray, if you could just bring up that website.
Unfortunately, Jason's having some technical difficulties in a hotel somewhere across the globe. But to his point, we are becoming, you could argue, in terms of not only population, but here geographic landmass, GDP, military might, all of these things that are happening as this union of countries grow against the West, we are becoming a minority, in this case, even in land space or in airspace. And yeah, so things that we take for granted, including traveling across the globe when you're going through where you would have to cross through airspace that is now closed down, these are the potential problems or the unintended consequences that come as a result of things such as weaponization of the treasury market, where we can steal $5 billion worth of Russian assets and use them largely to buy weapons to give to the Ukraine, the country that Russia is in a war against. That doesn't do so well for foreign relations, as you may expect. And the European Union is doing the same thing. They were just warned by Saudi Arabia that indeed, if you do this, which they just did, they took the interest off of the 280 billion in European treasuries owned by Russia, held in Europe, and they provided 50 billion euro, I believe, or $50 billion to the Ukraine in the form of a loan, using the frozen assets, using the interest that was generated off of the frozen assets. And Saudi Arabia said, if you do this, we'll start dumping treasuries, including starting with the French treasuries. That's just one form. But yeah, if things get bad enough, I could definitely see that being impactful in terms of airspace, in terms of tourism, in terms of all the things that we've taken for granted. My wife is Russian. She moved here when she was 2 years old. They're from Leningrad, or St. Petersburg, as it's called now. And I would love to have gone with her family back to see Russia, but obviously that's not going to happen any longer. These are ramifications of the type of irresponsible and hypocritical monetary decisions and fiscal decisions and unilateral decisions that the West is making. And unfortunately, this is something that doesn't seem to be on the waning end. It seems to be increasing. And I think you'll see more things like this as time rolls on.
Andy, could you tell us a little bit more about this other news that's come in this week about a proposed US strategic Bitcoin reserve and its funding mechanism through the reevaluation of the Federal Reserve's gold? What is that all about?
Trump was at this Bitcoin meeting recently, I think in Tennessee, that was just broadcast all over the place. It was a big deal that he was there. He talked about, if he got into office, having a strategic fund that would be funded with Bitcoin, and that they would purchase a certain amount of Bitcoin every single month. I will read to you a little bit about it here, but it says U.S. strategic Bitcoin reserve to be funded partially by revaluing Fed's gold. Now, I've been talking a lot about the fact that gold is held in an account across all the globe in every single central bank account in something called the gold revaluation account. You can't make it up. They know, the central bankers know, that this gold is sitting there in what is a perfect vehicle to help get the balance sheet in order. All you need to do is revalue gold the way that Roosevelt did over my right shoulder here in 1933, where he confiscated gold and devalued the dollar by 40%, thereby making gold worth 40% more. Well, what if you made gold $20,000? The head of the Dutch National Bank keeps talking about this. The head of the Dutch Central Bank, he keeps saying, our balance sheet's upside down, but we have gold in the gold revaluation account. In essence, we should revalue it. And what if they made gold unilaterally? The West made gold $20,000, or China does it. Instantly, your balance sheet goes from putrid to pristine, just like that. Now, what she is saying is that she says the Treasury can, with no congressional approval needed, instruct the Fed chair to revalue U.S. official gold, which mechanically creates a deposit into the Treasury General Account, the TGA, free and clear, that the Treasury can spend as it sees fit. We have intimated many times and now can openly confirm, thanks to Senator Loomis's proposal, that the United States policymakers absolutely know about the gold revaluation account and that it is a viable way to pay for things up to and including recapitalizing the U.S. federal debt. If policymakers are considering revaluing gold a little bit to create a Bitcoin strategic reserve, why not revalue gold a lot and recapitalize U.S. federal debt to put it on a sustainable footing over a weekend? At 261 million ounces, every $4,000 per ounce puts $1 trillion into the TGA free and clear. $20,000 per ounce would deposit $5 trillion into the TGA, and the Treasury market could use to buy back much of the long end of the U.S. Treasury market. I've been saying, Jason, that this is an option that I think all of the Western countries understand, because the world not only has been creating tremendous amounts of debt, but simultaneously they've been buying tremendous amounts of gold. So just like that, you revalue gold, which, by the way, throughout all of Europe is on the European balance sheets, including the UK, at $35 an ounce, still the Bretton Woods number. In the United States, it's at $42.22 an ounce. Don't know why it's different, but it is. They can make it whatever amount they want, 10,000, 20,000, as this article says, have $5 trillion to buy back the bonds that are bankrupting the government and to help pay for their unfunded obligations in Medicare and Medicaid and Social Security. But that doesn't even really change things a tremendous amount in the United States, but it certainly helps because our unfunded liabilities are of $99 trillion in Medicare Part B, 22 in Medicare Part D, and $77 trillion in Social Security. If you revalue gold and rein in your irresponsible fiscal spending, a country that's addicted to spending, you have a hope at righting the ship. And I think this is something that is really beginning to be noticed by the Western central banks. And quite frankly, I think The Eastern banks have noticed it long ago. And ultimately, gold will be, I believe, central to a new system, a tether to the irresponsibility of fiscal spending and the brain dead monetary policy of the Western central banks. So, yeah, I think this is one reason to hone gold, with expectations of it being revalued much higher as a way to get us out of a very sticky wicket, if you will.
Yeah, and I think of course we can combine and talk about this a bit more in future episodes. And of course, we can talk about the movement, that the grassroots movement that's happening across the United States and within the legislature and within the state treasury departments to actually use their constitutional right to enable gold and silver as money, because as of course under the Constitution it does forbid all states to make anything a currency except
Well,
gold and
and
silver.
Jason, I'm going to give you some kudos here because I don't think people know, and someday they will, um, how much of an effort you've put into doing just that and put gold back on the map as wealth and as money. And I do think that is a topic we will cover quite a bit in episodes moving forward, and you should be commended for that. But indeed, there is a big push around many of the states in the United States to recognize gold as what it was in the Constitution, as money. And if we see all of these states recognize gold for all debts, public and private, including things like paying your property taxes, I think there's hope. That to me represents the American spirit, where we've done our best with our backs against the wall. Hopefully, we can find a way to become a little bit more united rather than so divided, because that has also been a key to things. But certainly, in a economic calamity, I think those types of distortions of unity, lack of it, become much more polarizing and much more troubling. So indeed, to me, gold is that anchor, that one anchor that can help regain credibility in a system that seems to have lost it, and largely due to our own stupidity by weaponizing the dollar and, in essence, stealing the Russian assets when the world looks at us as being hypocritical in doing so. And quite frankly, it's not for the world reserve currency to make these decisions. At the same time, we are creating $100,000 in debt every second. One, two, three, four, and 24/7. That we're bankrupting our children and future generations. And at some point, the rest of the world says, I don't want your treasuries anymore. I don't want your dollars anymore. And I find it ironic that in all of this talk about gold is Judy Shelton, who, if Trump were to win, will probably be appointed the head of the Federal Reserve. She's a gold advocate. She advocates being on the gold standard and also talks about 30-year treasuries guaranteed in gold, where how do you inspire confidence in a market that lacks it? Peg it to gold. Same thing would be true about the treasury market. So a lot to be said about where gold is going in the future and
Yeah.
how the United States and the individual states view it. But I think a lot of us owe you some thanks. And I think we'll talk about that more in future episodes.
We will. Unfortunately, we've got to stop now. We could listen to you all day, Andy. Some amazing insights that you've got and really amazing set of information you've been giving us today. That's all we've got time for today. Thank you for listening. Let's make sure you subscribe. Tell us your thoughts. Put them down in the comments below. We've got exciting and unmissable guests lined up, so you don't want to miss those. We'll be talking about some of these things about US states later before. Please follow us across all social media platforms. The links should be in the description, so you can receive the latest news and information about upcoming guests and topics. Yeah, Andy, thanks again for a great talk. And everybody, we'll see you later. We'll see you again next week.
Safe travels, Jason. I look forward to that, my man. And everyone else, have a good one. Look forward to picking up with you all next week.